Hello, everyone, and welcome to the third webinar in the series on investing. And the title of today's webinar is Thoughts on Portfolio Building, Asset Allocation, Concentration, and Diversification. Now, building a multi-bagger portfolio is not an easy task, and we are often uh, struggling with ideas on how to uh, select stocks. How much should I buy of a particular stock? Am I concentrated enough to get maximum benefit of the stock in my portfolio? Am I diversified enough to uh, de-risk myself? And a host of questions of whether I'm doing the right thing, and am I doing it in a scientific manner, and what should be the so these are a lot of issues which people struggle with. And on multiple WhatsApp groups, I've come across extensive conversations where different people have different iterations. And what I have done is, in my learnings from everyone and from the masters of investment, I have formulated a note in a and or a format in which you can go about converting this art of stock picking for portfolio allocation into a some kind of, not a science as strictly as that, but into a methodology which can give you a template for having some kind of discipline in your stock picking. And it is not ad hoc. So it has got its own uh, fair share of stocks which are turnaround plays, which are growth stocks, which have got stability to put a portfolio. You have cyclicals in that. So we have designed it in such a way that it would definitely benefit uh, all of us, right? So keeping this in mind, let's, without much ado, let's get on to the presentation. And I will just be sharing the screen. So just be with me on this. Right. So although I've called it thoughts on portfolio building, when I decided to build this webinar, I said, why not build a high growth portfolio? Isn't what we all want? We want growth in our portfolio, and we want to make maximum money as fast as possible. So let's see what are the checklists for tracking the markets. Okay, so here what we are going to do is we are very quickly going to iterate what we learned in the previous two webinars. The first one was on integrating top down with bottom up, and then mining the sectoral landscape for easy stock picking. So what I've done is, in just a couple of slides, I have inculcated the previous summaries of the previous talks, so that there is a good flow for people who may have missed it, and for those who are attending the third webinar in the series, congratulations to you. And so that it's like a brief recall of everything. So first of all, what we need to do is we need to assess the macro. It is very imperative to have a view on where the economy is going. Investment cannot be done in isolation. Markets don't move one way. The lot of mutual funds keep telling us about, if you had invested money in this year, it would have grown to the 10 times, 20 times. Yes, but there have been many dips in that market where you have taken drawdowns too. So you cannot just blindly put money in the stock market and hope that it will become a high growth portfolio. No, we have to move with the markets. And hence, it is very important to have a view on where the economy is going. And to know that, we start with prima facie political stability. To my mind, as I've said earlier, it is the most important aspect of leadership. That is very important, because leadership drives the policy, and policy drives momentum in the markets. So, actions taken by a government last for 3 to 5 years beyond their term. We will come to this. So if you remember, when the uh, government of Vajpayee collapsed, or rather they lost the elections, what happened? The momentum continued for very many years. Okay, when Sonia Gandhi's government or Manmohan Singh's government came into power, they did nothing. And that impact lasted us from UPA 1 to UPA 2. UPA 2 was extremely bad. Of course, it's not fair to put all the blame on them. But what happened was we were left with a legacy of some very unsound financial uh, position when the Chidambaram quit in 2014. It is purely due to Modi's astute handling of the economy and working on a war footing that we have been able to salvage what was the precarious nature of our economy. Perhaps we are extremely lucky to have Mr. Modi to run our country. Otherwise, we you would have you have no idea of what kind of shambles we were in 2014. It is surely due to his alacrity and his timeliness and his commitment and sincerity to pull the economy back on track that has worked wonders for us. But having said that, I don't want to get too much into this political rhetoric. We just move on from here. So, hence, it is very important to have a 3 to 5 year bird's eye view on where the economy is headed. Okay, now you should see all of these things in correlation to GDP. So, how the GDP will be impacted, what is going to happen, the interest rate trend. Are we trending up? So, right now we have for we were in a decreasing interest rate trend for 4 years. Now we are moving up. Okay, so what is going to happen? P's are going to compress, right? So the massive P's that you have seen in yesteryears will not be there. Okay, have a look at currency movement. Rupee is going down. Will it be the same trend? Inflation will pick up. So all these things we need to have a look on. And I will agree with you that it's when I tell you to form a 3 to 5 year kind of view, it is not possible to do it. But you need to have a 3 to 5 year view, because if you're building a high growth portfolio, that is your horizon, isn't it? Your stocks need to breathe, they need to be invested. And hence, you must have a 3 to 5 year view, and you review it every 3 months. Okay, on what the macro is doing, how the economy is shaping up. Every 3 months you should review this to ascertain how your stocks will move, and how the economy will move, and how the PE of your the valuation metric of the market will move. More of that later. But these are very important tenets that we need to keep in mind. So coming down to the next thing, once you have taken care of all the macros that have impact us, we now get down to the policy measures of the government. So, India has a very big government, and there are very many areas of the market, of the economy, and you should spend time poring over all facets of the different ministries, list down all the things that they have been doing, talking, without giving thought to relevance or irrelevance. So once you have collated all the information of the various ministries and made a very, very healthy, how could I say, organized format of storing the information, you should ponder on these policy decisions with respect to the outcome that they will have on the sectors of the economy. And this will lead to an assessment to which economic factor is going to do well, will be impacted positively, or will be impacted negatively. And very simply, what we do is so this is what we call mining the sectoral landscape. So we go with the product categories where we think that policy measures are positive, and we focus on stocks in those segments, right? So this is the top down method of analysis. Now, having segregated the positive negatives, take each sector and build on the narrative in the typical fashion of industry analysis. So, look at all the factors, the portals, models, the demand, the supply, factors affecting demand, factors affecting supply, pricing, uh, competition, disruption, uh, extensions, usages in different sectors, installed capacity, production levels, capex, all the works, the returns, the margins, everything. Look at all this thing in perfected, and having after having satisfied yourself on the industries which are going to do well. Establish what stage of the bull market you are in that particular industry. So has the industry already been doing well in the past? So you're not a preliminary stage, right? You're probably in the middle stage. Or has uh, the tailwinds been on for very long and now we are into headwinds? We are entering the mature stage of the cycle. So if you're in the early stage, not much will be known about the stocks in this sector as they're off the radars of the investors community at large. Here, maximum money can be made. So I'll give you an example. 2 years back, if I had asked you to buy steel stocks, nobody would have touched them with a barge pole. Or let us say 2 years again before, if you were asked to buy chemical stocks, no, you would not have had any idea of what it is happening out there. So what happens? It is these stocks which are in a very preliminary stage where you can make the maximum money, you know. And what happens is once those stocks have been discovered, in the established phase, there is clear evidence of which players are benefiting, you know. So we will track only those stocks. So all things are known. We know which stocks are going to do well, right? And once we know which stocks are going to do well, we will do the research on them. We will have a numerical order of from the best to the least growth stocks, and then we will decide which stocks to buy into. Then we come to the mature stage. In this, all is known, everything is done with. Like, for example, if you take uh, the example of the consumer stocks, everything is known, right? Everyone knows it's a consumption story. So all is known, so that there is not enough lack of knowledge where you can thrive on if you have a edge, right? And hence, in this kind of a market, valuations become extremely critical. So let's just go back a bit. Let's rewind 1 minute and let's reiterate this because this is very important. So if you believe that the industry that you are selecting in is at the initial stage of the rally, then you will stand a chance because you will do very well because not much is known about it. So if you have an edge there, you will do very well. Now, once you come into an established place, there's clear evidence of which players are benefiting. So we will track only those stocks, right? And what happens in the mature stage, you know that all the story is done and dusted, the whole street knows about it. And when you are in that kind of an environment in the market, okay, you should then focus very, very heavily on valuations. Because now what will happen is the stock which is the cheapest will provide you returns with a margin of safety, right? And this, in short, is the principle of zeroing on stock ideas. Okay, this is how you should zero in on stock ideas. Now, there are other approaches for picking up stocks. You can do the bottom up approach to identify stocks. So, how can we do this? You know, so one way would be to take broker reports, prepare screeners for valuations of next 3 years. For example, let's take the banking industry we saw last time in mining the sectoral landscape. In that, what we did is we had got 3 years projections. So we put all of them together. We prepared a compendium of all the banking stocks. And what you should do, as suggested in the next step, is filter stocks that are showing at least 60 to 100% growth in earnings in next 3 years. Mind you, I'm not saying 60 to 100% year on year growth, but the difference in FY18, so let us say if a stock is earning 100 rupees of EPS this year, it should have at least an EPS of 160 to 200 in FY21. Okay, so if you're not seeing a reasonable growth path, okay, there is no sense in buying that stock. So, prima facie, what we will do, we will pick up stocks which are uh, going to give us 60 to 100% growth in the next 3 years. Then what we do is use this list to do the stock selection based on the learnings of our course. So you will learn in the course with me on uh, multi-bagger stock investing, what needs to be done. And what happens is typically in a bull market, stocks that double earnings in 3 years will double in 2 years. Okay. So if you follow this methodology of picking up stocks and putting them in the bracket of 60 to 100% growth for the next 3 years, and if you get a good stock which meets all the principles of fundamental investing and has got 100% growth potential over 3 years, that stock, to my mind and experience, I have found that it doubles in 2 years. Okay. So what we should do is we should make a list of at least 150, 200 stocks, which will provide you with a very eclectic list of stocks that you need to focus on. And what happens, you can time entry into these stocks based on valuations or other timing tools. So you know what, you have a list of stocks, but you don't know whether to get in now. So what are you looking for is entry point. So let us say, to give you a very classic example, is RBL Bank, okay, was for a very long time trading over 500. So it is there in my growth stock, but it was not fitting into the valuation criteria. So once from 540 to 580 market, when it came down to 470 levels, it gave me a chance to look at that stock so that I could see 100% growth in 3 years, doubling in 2 years. So then I would zero in on that stock, right? So you can time your entry into these stocks on based on valuation or other timing tools. Okay. Although we teach you fundamental valuations, we respect all formats of analysis, be it technical, cycle studies, astrology, whatever. So whatever timing tools you use, you could use to get them. Most importantly would be, if in the 150 200 stock universe that you have built, significant corporate action happens in any of one of those stocks, that can be a trigger point for your analysis. So to give you an example is that, let us say that because of the US trade war, okay, you have a situation where China imposes tariff barriers on US cotton entry into that country. So immediately what happens? Cotton stocks in India, because India is the next best high largest producer of cotton in the world. Cotton would be sourced from India, right? And because cotton is being sourced, and this being the season for planting crops, what you can be sure is that because of this trade ban, this cotton seed would be much in demand, right? And so if you have stocks like maybe Kaveri seed, Nath seed, JK Agri Genetics, etc., in your list of stocks, then suddenly what happens? This is triggering action for you to time entry into that stock. I hope I have made this point very clear to you. Another way to pick up stocks is to see stocks with new lows. So stocks are hitting new lows, right? Not everyone will be at the low point always, but these stocks which are hitting at new lows become your entry point, for your starting point for evaluation of stocks. So give you an example is that uh, some time back, uh, a particular stock had got sold off massively. Okay, nobody was looking at it. Just to give you an example, let's talk of JSPL. Okay, the stock was hitting new lows, and there were extremely bad information about it just over 3 years ago. So when we did our research, what we found is that the company is expanding capacities, and they're primarily into the long segments. Okay, they are not into the flats, और इंडिया में flats का imports नहीं होता है ज्यादा. So we had identified and kept it. And the day the government hit the market with uh, protective duties with the anti-dumping duty, this was one of the few stocks which rallied the fastest and the most. Okay, so this is an example of how you can use a low point to buy into a stock when you're going ahead with it. Another point for analysis and for identifying stocks is to use insider buying lists which come in the news press. So you'll be looking for promoters buying stocks. So give you an example is HEG. When the price was about 475, the promoter was buying huge quantities from the market. And in the con call, he was even asked, why are you buying the stock? So his answer was, I buy the stock for the same reason that you are buying. Right? So what was it suggesting to us? That he was seeing bull market in his stock, right? And that was a trigger point to buy that stock. Today, that stock is more than 300,000 rupees, and it has given you a 7% return, 700% or 7x return. And it would be just about a year now, you know. So this is how you can pick up a stock. Another stock to buy is to see what mutual funds are buying, right? That's also another point where the smart hands are buying something. And you should maintain all industry data meticulously be tracked, and historical data of at least 10 years should be maintained. Irrespective, I personally maintain data for 20 years. So, to give you an example, I will track auto data for 20 years, and auto is very cyclical. So let us say CV stocks, they're very cyclical, and CV cycles are uh, 2 years down, 3 years up, sometimes 2.5 years down, 3.5 years up. Okay, so when these cycles are going, that I would like to know the intensity of the cycle, number one. Number two, I would like to know in what stage of the cycle we are in, because based on that you can estimate what kind of profit margins they can do. So let us say in the last cycle, say 2003 to 2008, interest rates were very low, right? And they had EBITDA margins of 15-16%. And this time interest rates are high. So, and I'm expecting higher interest rates. So I know that the cycle will play out, but the EBITDA will not be that rosy as it was in the past cycle, right? So I am estimating if in the last cycle the EBITDA was at about 15-16%, this time I'll go at 11-12%. Are you getting my point? So then I'll tone down my expectations on that. So this is the way how you can use data. You can use insider buying list and mutual fund buying to come out with stock ideas. So this is what is zeroing on a stock is all about. And I hope that I have provided you with an excellent starting point for identifying stocks, maintaining data, zeroing on stocks, using timing information to enter the stocks, and having data and how to manage it and how to interpret that data and how to use that data, right? If you would like to learn this kind of analysis, you should definitely take up the course which is starting on July 15th. Okay, so don't hesitate. Look me up on WhatsApp 7021216247 or email me at School of Market Studies. So now that we have seen the facet of buying a stock, how to analyze a stock, and how to zero in on a stock, let's get to the concept of building the portfolio. Okay, so now we are seeing converting the art of stock picking into a science. How do we go about that? Number one, establish the size of the player compared to other companies in the sector. So let us take uh, the example of the seed industry. And there are three players out there who are significant. One is Nath Seeds, one is Kaveri Seeds, and we have a slightly smaller player called JK Agri Genetics. Okay, of course, Monsanto was there, but I'm not taking that into play because they're just not comparable. Okay, now the stock in question which I'm choosing is JK Agri Genetics. Okay, so I will establish the size of the player compared to the other companies in the sector. Are you getting my point? So I will compare. this JK Agri Genetics with Nath and with Kaveri, and then put it together. Okay. Now, once you have done this kind of analysis of the sector, what you need to do is the stocks that you have chosen, you will have to put them into categories of uh, of six variety, which I will now outline for you. We will call slow growers. So these are stocks which are mature industries, growing at 8 to 12%, 5, 6%, slow growth EPS growth stocks. So one sleepy stock that comes to mind right now is Larsen and Toubro. Okay. So typically it has been growing like that for quite some time. Whether it will have resurgence going ahead, well, that only time will tell. But as far as I am concerned, we are not seeing more than 8 to 12% growth in earnings from this stock. Then there are certain stocks, for example, like Titan, or you can take Hindustan Lever, or you can take uh, Imami. All these stocks which have really given well, they have performed extremely well in the past. Major re-rating has happened, and now they are established businesses, and they are still growing, and they are growing at between 12 and 20%. So what we call them is stocks with stability. So HDFC Bank, Kotak Bank, these are all star performing stocks. Okay, so they're going to give you 18-20% CAGR growth. Your uh, and there is a lot of confidence that the growth factor will not deviate too much, because everything is established. Then we come to the third category, which we are primarily interested in, which are the fast growers. So we are looking to find stocks whose EPS will go between 20 to 25% CAGR, or which I told you, between 60 to 100% growth over the 3-year period. Okay, these are what we are interested in. Fourth category is the cyclical. So if you take steel industry, shipping, or you take metals, or you take agri stocks, which are absolutely cyclical, right? Those are the ones we would classify them in that fashion. Then we look at for asset plays. So let me give you an example of an asset play, a Bajaj Holdings or a Bombay Burma Trading Company. These are all companies which are holding in nature, but they have sizable assets in the form that their holding companies are very fast growing companies. And इसमें क्या होता है is that the risk is low and the returns are higher. So when you have this kind of a company which is an asset play, if it clicks, then with limited downside, you have potential upside, significant upside. So we like to have these kind of stocks in the portfolio. And finally, we have a category which is called turnaround stocks. So we are looking for stocks which are going from loss to profit or dipping performance, becoming better again, right? And these are the stories where we are going to get maximum return. So categorizing stocks into this kind of context of the six variety will give you a better of idea of what to expect from them, right? So you are not doing anything in the air, or it's not arbitrary, or it is not even how to put it, it is not guesstimating or anything. You have a clear defined view why you bought a stock. You classified a stock like, say, Larsen and Toubro, you called it a slow grower. You bought HUL and you said it's a star performer, and you bought a stock like RBL Bank and said it's a fast grower, right? And you picked up maybe a Tisco, said it's a cyclical, and you picked up a Bajaj Hindustan, which is a asset play, and in turnarounds you might have picked up a company which is turning around from the government. So let us say a stock like JP Associates, a turnaround play. Things have gone bad, restructuring happened, company is going to come back, or a SBI could be a turnaround, or an ICICI Bank could be a turnaround. So you know exactly why you bought the stock, what are the kind of returns and expectations are there, what is going to be your holding period, and how you expect them to perform, right? So categorizing stocks in these six different formats will really go a long way in bringing some discipline to your stock picking and getting to have an idea of what kind of a return you can expect from a particular stock. Okay, now I would like to just take you back again to the presentation on the top bottom investing that we had done the first one. You know what you need to do is keep track of industry growth rates. When I say that, what do I mean? I should know at what percentage the industry is going to grow. So let us say banking. So banking universally has never grown below 1.25 to 1.5 times the GDP, right? Nominal GDP. So let us say your real GDP is 7%, you have inflation of 5%. So you have typically got 7 and 5, 12% inflation, and I'm looking for 1.25 to 1.5 times GDP. When I say 1.25 to 1.5 times, what does it mean? I'm looking for growth between 15 to 18% in credit growth. Okay. So you should pick up stocks in an industry in which you expect growth to be faster than the industry growth. So let us say an industry in banking is growing at 18%, right? 15%. And you pick up a stock like, say, uh, Indian Bank, which is growing at 12%, you're shortchanging yourself, isn't it? So, in a sector which is high growth, if you pick up a low growth stock, you're obviously going to underperform, right? So, we keep track of industry growth rates, seek correlation with GDP, both nominal and real, and other macro parameters, right? So, in this case, where we did the HDFC Bank, if you remember, we spoke about GDP growth, we spoke about system growth, and you can see historically, if you see the numbers in red and green, HDFC Bank throughout its history has grown minimum of 1.4x system growth and 2x GDP growth. Okay. Then, as I said, within each industry, we're looking to select stocks that will outperform sector growth. So once having done that, identified stocks that we want to buy, having categorized stocks, comes the question of how many stocks to own in a portfolio, right? So some people say you should have a concentrated portfolio. I have a friend of mine, a very dear friend, who does only 4 stocks. And I have another friend of mine who's got 80 stocks in his portfolio. Mind you, he's done fantastic. He's doing extremely well. So on one hand, you have a person who has a concentrated portfolio. On one hand, you have a guy who's diversified his portfolio. Now, let us say you have two stock ideas. Okay, uh, a slow growth stock which you very much like let us say you took Larsen and Toubro and you took RBL Bank. So Larsen and Toubro at 1200 at 1300 rupees. Let us say your expectation is that the stock is going to go to 1500 rupees. So you're looking for a 200 rupee jump, right? And RBL Bank, which is say around 500, and where you're expecting the stock to also jump by 200 rupees, but which is going to give you a 40% return. Okay. And you allocate equal amounts to both. Let us say you allocate 2000 rupees to L&T and 2000 rupees to RBL Bank. So RBL will become 2800 rupees, and this one where you're getting 200 rupees return on 1300, you're getting a 15% return. So on 2000 into 1.13 will give you 2260 rupees, right? So you get 2800 and you got 2260. Now, if you had done the allocation of 1000 to L&T and 3000 to RBL Bank, your return ratio would have been much better, isn't it? So the allocation issue, the concentration, and the diversification issues are dilemmas that people face. They don't know how to give how much allocation to give to a stock. That is why, if you know, if I go back, uh, if I go back here and if I know that RBL Bank is a fast grower and over 3 years I'm going to see my money double, and Larsen and Toubro is slow moving stock, and that is only going to go to that 20% return in 2 years, then does it make sense to allocate, say, 10% of your portfolio to Larsen just because it is a blue chip? No. Your money should be with the fast growers because you have done your homework and you think that the stock will grow 25 to 30%. The downside risk seem limited, and hence your allocation across your portfolio should be dynamic. It should be more towards fast growth and lesser towards slow growing stocks, right? So this is the question of allocation and identifying, classifying stocks into these uh, 5 6 categories will help you to allocate a portfolio where it will give you maximum bang for your buck, right? While at the same time taking into consideration the risk factors involved. Okay, so this is my take on how many stocks to own. So I believe that if you have an edge in a particular segment, or you have uncovered an exciting prospect that passes all tests of research, then you should own as many of these stocks as possible. Okay. So let us say you have an edge in the chemical industry. You're a chemical engineer, you understand chemicals better, or let us say you are a pharma person and you understand the pharma sector better, which has got less understanding on the street. Or let us make it more specific. Within pharma, you understand biology, biosimilar market very well. So biocon, you have a thorough understanding which the market doesn't understand. You have an edge there. That stock should be with you. Let us say you are a jeweler. You understand Thangamal jewelry. You should have that stock. Let us say you are a jeweler, you own jewelry stocks, you understand pharma better, and you have got a very high, you have uncovered a very exciting stock in the FMCG segment, which you feel has passed all the tests of research. Okay, mind you, these tests of research is what I teach in my course. It's called the 12 dynamics of multi-bagger stock picking. And if it's passed all those tests, then what do you have on hand? A very, very good, well thought out investment strategy. So you should own that. And if you have 50 of these ideas, you have 50 of them, you own 50 of them because you have an edge, you have uncovered an exciting prospect. Okay, so you should own these stocks. Typically, if you do not have any kind of edge, or you do not have an exciting stock in hand, then you should at least be owning between 3 and 10 stocks. I think owning 3 is loading the risks against you. And if you are looking for 10 bagger stocks, okay, the more you own, the more likely that one of them will be a multi bagger. Let me explain this to you in a bit. Okay, you estimate that you have got 5 stocks A, B, C, D, E, and you think they're all multi baggers. Okay, but a multi-bagger will be proven only after the event is done, right? Only when a stock has gone up many times can you call it a multi-bagger. Now, what may happen is that out of A, B, C, D, E, only A may have gone up 10 times, B may have doubled, and C, D, E have still not performed. So they're still multi-baggers according to you, but they're taking a little more of harvesting time. And okay, if you had bought only E, wouldn't you have missed out on A? Or if you had bought B, C, D, what would have happened? You would have got B and C, D would have missed out. But you will never know which of them will be multi-baggers. So if you have picked up a few stocks which you think are all multi-baggers, Ideally, you should own all of them, because the return that you will gain from one of the guys who flies out will more than make up for the uh, lower return from the other stocks. Okay, they might be multi-baggers too, right? So one might double, another one might double in 3 years, another one might treble in 4 years, and A would have gone up 10x in 1 year. So you don't want to miss that, right? Because that 10x will make up for the remaining five. So this is what I mean. So if you are looking for 10x stocks, the more you earn, the more probability that one of them will be a multi-bagger. Then comes to the factor of allocation. So we spoke of concentration, not owning too few stocks. We spoke of diversification. So coming to the concept of diversification, what we are saying is that not necessarily in this order, but I personally believe that the 30 to 40% should go in growth stocks, 10 to 20% in star performers, which give you the stability to your portfolio. So if the market is down, they will still keep doing well, which is happening in our markets right now. So, if you had between 10 to 20% of your money in all the blue chips which are doing well in the market, or the star performers, your portfolio would have been saved, right? Because we have seen growth stocks really fall off. 10 to 20% should be in cyclicals. Cyclicals are a very dangerous territory. So allocation should not be more out there. And the rest should be in turnaround stocks. So let us say you allocate the lower side of it, 30, 40, 50, then you put 15 turnaround stocks. Okay, because it is turnaround stocks that is going to make you maximum money. See, they are not discovered, market doesn't know them, right? So there is one particular stock which I think is a turnaround, Hubtown. So I would make it a part of my portfolio. Okay, JP Associates, I think I have an edge there. It's a multi-bagger. It'll be a part of my portfolio. Okay, so that is the way to go about building the stocks. I'll have a RBL Bank, HDFC, IndusInd, and Kotak as star performers. Uh, growth stocks, as growth stocks. In star performers, I will take Bajaj Finance, Bajaj Finserv, uh, a Godrej Industries, a Godrej Properties. So I'm just throwing out names to you just to for you to get a feel for what I'm saying. Okay. And now let's come to a few other factors that we should look at. Okay. Look for small profitable companies with a proven concept and that which can be replicated. So obviously, money is the multi-bagger returns are not going to be made from a Titan at 900 rupees, isn't it? But you should look for small profitable companies which have a proven concept and which can be replicated or it is scalable. Those are the stocks which will make you big money. So to put things in perspective, if you look at the stock of Thangamal Jewelry, as I told you, they've got a proven model down south. They're just like Titan is a trusted bank, Thangamal is a trusted bank in Tamil Nadu. And if that brand does well, and let us say they branch out and they do well, boom, they're going to do really, really well, right? So you should look for small profitable companies where proof of concept is there, or let us put it in modern startup parlance, is that the MTP is established, you know, and the scale has to be achieved. Then another thing what you should understand is that the more stocks you own, the more flexibility you have of rotating funds between them. So let us say that you have got three uh, star performers and one of them goes up 50%, and your estimate was that stock would do about 60% return. Okay, and you got 50% and in a very short span of time. So why not uh, disallocate from there and reallocate to the other two stocks in your star portfolio which have still not given you that kind of returns? Okay. And now you have to remember there is no long term capital gains benefit. You have to pay tax. So there is, why should be there? So you should not be afraid to switch. Then when we come to the concept of asset plays, these are absolutely low risk, high gain stocks, isn't it? As I told you. Now, assuming that you are sure of the value, you've done all your homework. So let me give you an example. Uptown market cap is 600 crores. They've got debt of about 2,500 crores. And I believe that all their properties, if they get sold over the next 5,000 years, could possibly fetch them close to 4,000 crores. You know, so even if I say reduce the debt by 1,000 crores, 500 crores of market cap, my expectation is they'll sell property worth 4,000 crores, they will earn. Then what I get is that 3,000 crores would be the return on 500 crores in a period of 4 years. You know, so they have this asset, they're sitting on an asset which is not being analyzed by the market. And if I believe that it is going to give me a return, then bang on. You know, these are asset plays. They are going to give you a lot of money. So value the asset, look for hidden assets, deduct for debt and creditors, and you know the value. Okay. Another thing, just like we said, every 3 months we should review the macro situation because we are in a dynamic global economy. Things keep changing. One day you have Greece blow up, another day you have a trade war, another time you have a Kim Jong Un doing something, and then you have maybe a nuclear leak, or you have oil prices shooting to the roof, or uh, you have a flooding, or you have drought. So these things keep happening and things change dynamically. So our world has become such. So in the same way, just like you keep on checking on the macro, you should revisit your stories every quarter, and you know uh, assess your calculations that you have done, minus it, add on to it, you know tweak the margins, do the things just like an analyst would. Okay, this helps to add and subtract to positions as things change. So to my mind, RBL Bank is, I like RBL Bank, right? I said it's a high growth stock, and 3 months down I realize that RBL Bank has given me a good 35% return. Not too bad, it's in line with my keeping. But what I'm seeing is that the story in ICICI Bank is getting much more sweeter. Okay, there is more juice there. So there is no harm, because ICICI Bank is also part of my high growth portfolio. There is no harm in allocate, reducing allocation to RBL Bank and moving it into ICICI Bank, right? So this is what I mean by constantly checking, rechecking stories, adding and subtracting to positions as things change dynamically. And finally, moderately fast growing companies in non growth sectors are ideal plays. So let us consider two different sectors. So we'll take the case of Bajaj Corp and we'll take the case of Jyoti Laboratories. So if you see in Bajaj Corp, they have got almond drops. Okay, that category as such is not growing, right? And neither is almond drops growing. So that is a slow growth company in a slow growth stock. On the other hand, let's move to um this company which I spoke to you about, Jyoti Laboratories. They have this blue liquid detergent which is Ujala, right? Now Ujala is the only player in its category because they're the monopoly brand. Okay, there's 70% share. And although the sector is not growing in its core markets, the non-core markets have started giving growth, right? And it also is can and it has also got price stability. So I can raise price anytime. So I have a moderately fast growing company in a sector which is quite stagnant. you know so these type of companies, they're extremely idle because they have market share, and they do very very well because they eat market share from competition, and then they grow. Another thing that I wanted to highlight to you is a very very important thing, which is very very relevant to markets today. Okay, I think over the last 2 years, anyone and everyone who had got a few mid cap and small cap ideas in his portfolio that went up 10 times thought he was a portfolio manager, and they decided that multi-baggers are the way to make money and they're going to here to stay. And these people are unpleasantly surprised by the way the market has brutally eroded their portfolios. Okay, so rather than being in multi-bagger stocks, you know, where you have large potential but you don't exit and you have large drawdowns, what is the harm in being with star performers? Okay, take the case of HDFC Bank. In 2 years, it's doubled. Take the case of RBL Bank, it has doubled in 2 years. 280 become 500 something. Take the case of IndusInd Bank, that has doubled. So if you have a portfolio of stalwarts, okay, and you keep rotating between them because they keep meeting their targets and you move to the other one which has not moved up, aren't you going to make the same kind of return that you would expect from a multi-bagger and with reduced risk? Isn't it? So let us say you classified pharma as a stalwart. Okay, recently we had a run, stocks moved up. Okay, from there you exited, got into banking stocks moved up. From there you got out, got into FMCG because they started moving up again, or maybe IT. So if you are having a portfolio of stocks which are moving in sectoral rotations, and you keep moving money out from there into places which have not yet moved, you will generate the same amount of return that you would from a multi-bagger, which carries huge risk of drawdowns and non-performance. Okay. So now that we have warned you about multi-baggers, let's now talk in favor of multi-baggers. So growth stocks. Growth stocks are to be held as long as their earnings are growing. The expansion is coming and that there are no impediments. So what are you looking for? You're looking for a stock which is growing between 60 and 100% over the next 3 years. Okay. And as the earnings come, they keep clocking the returns, right? And the growth factor is there. So if he's growing 20%, next year is growing 20%, next year is growing 20%, great. Example would be uh, DBL Limited, you know, the infra company. As long quarter on quarter the growth was there, the stock kept moving up. So from 200 and odd levels, it went to 1200. The moment the market sensed that this growth is not sustainable, the stock was hammered. Okay. So we need to be sure that the earnings momentum or the growth of the earnings will keep sustaining and the expansion will keep coming and there are no impediments to the story. Mind you, we also see what are the impediments. Okay. So as long as that is happening, what will happen? The stocks will continue to perform. And if you find that the story in a fast grower has rallied 50% and now the story sounds a little dubious, rotate your funds into the second fast grower, which if it has not done much, and the where the story is sounding relatively better from this story. So I'm not saying that you rotate immediately. Let us say you have stocks A and B. A is doing very well, uh, and A give you 50% return, and now you're saying, well, I'm not so sure after checking all the facts. then why not move that funds into the B stock? Okay, which may have still not done. And now the story that sounds very attractive, right? So this is where the basket approach of investing definitely helps. And couple of things more. Devote study time for companies from all types mentioned above, especially turnaround, as maximum money can be made there. So if you think there is a turnaround play that you have on hand, go into the depth of it, do the analysis, do all the situation analysis, spend more time there, because the time spent there is worth the returns that you will guess. And finally, keep checking for insider buying, because an HEG might be lurking around. Well, thank you, folks. Thank you for being on this webinar. I really hope you enjoyed this. I've tried to make it as informative and as interesting as possible for you guys. But mind you, my course on picking multi-bagger stock ideas is just as juicy, informative, and analytical than you would expect. It does not get any better than this. So we are starting on July 15th. Okay. Hit me a WhatsApp 7021216247, or drop me a mail on schoolofmarketstudies.com, or connect with me at LinkedIn. Look for me at Vinith Bolinchka, or on Twitter. You can get me under SMS Vinith, with my handle is at the rate SMS Vinith. So thank you, friends. And that's all for the day.